Hello, everyone. My name is Christian Marrero. I am the founder of Good Eats FX LLC, and I want to welcome you to Market Structure 102. We're going to be building off of our previous video, Market Structure 101, and our focus today is going to be building narrative and context so that we can trade in the live markets. Here's the table of contents. We are going to follow 6 major sections here, including market structure and location, liquidity and market structure, displacement and sponsorship, gap formation, and interbank dealing ranges. So you've made it to Market Structure 102. In Market Structure 101, we learned how to read price. We covered trends, candles, swing points, market structure, market conditions, and the 2 types of market structure shifts. By the end of that book, you should have been able to answer one simple question: what is price doing? But understanding what price is doing is only half of the question. The next step is going to be understanding why price is doing it. This is where narrative begins. Narrative is going to help us develop a directional bias and understand market intent. When we're able to identify where we want to participate in the market, this book is going to be able to take it to the next level to combine structure, liquidity, displacement, gaps, dealing ranges to create framework for trading. So the goal is not to predict the market. It's to develop a logical narrative that helps us make informed decisions. So market structure and location. Where is that structure forming? That is the question we need to ask. Location matters. A bullish structure forming in one area of the chart may have a completely different meaning than the same bullish structure forming somewhere else. So before we can develop a directional bias, we need to understand location. So the takeaway for this page is before we get started on looking for a bias, we need to understand where we are in the chart. So let's talk about understanding trading ranges. I just want to let you know for this book, we're going to focus on all examples being catered to the 9:30 open, and we're going to be referencing previous day range from midnight to midnight. A trading range is going to be created between 2 points during a window of time. And for day trading, we focus on previous day range, midnight to midnight. And I am talking in New York time zone. Here's a visual of what I'm talking about here. So when price is trading up to this point, 9:30 in the morning, we're referencing range based on a time window between this high and this low. Okay, let's get right into chapter 2 and let's talk about liquidity. So now that we understand the market structure and location have a meaning in what we're learning in this book, we need to understand what drives price from one area of the chart to another. That force is going to be liquidity. It's the most important concept in trading because markets are constantly looking for it. Before we understand reversals, breakouts, or new trends, we need to understand liquidity first. So, what is liquidity? It refers to areas where orders are likely resting in the market. These areas attract price because they provide opportunities for large participants to buy and sell efficiently. So, as traders, we are interested in liquidity because price is often drawn towards it. But think of liquidity as a magnet, it's constantly moving from one pool of liquidity to another. There's types of liquidity that we're going to be talking about in this book. There's the buy side liquidity, which is found above swing highs. This is where the stop losses and buy stops are likely resting. Price is drawn up to these areas to liquidity before it moves lower. And for the sell side liquidity, it's found below swing lows. This is where stop losses and sell stops are likely resting. So price will be drawn down to these areas of liquidity before it moves higher. And the third type of liquidity we're going to talk about is intraday liquidity, which will be short-term liquidity within the current day. So examples of this are going to be like I showed you in the previous slide, previous days, high and low, or different trading session times, which we'll talk about later on. But just to give you an idea, there's Asian trading times, London session trading times, New York pre-market trading times. So that will be referring to intraday liquidity. Here's the key points to remember. Markets are built on liquidity. It's the fuel behind the price movement. Price seeks the liquidity before making a significant move. Liquidity is important because understanding it gives context to market structure. All right, let's talk about why market seeks liquidity. One of the biggest mistakes beginners make is believing price moves randomly. These markets are not random. They're constantly seeking liquidity. Price will move towards areas where large groups of traders are likely positioned. This is why we frequently see highs get taken or lows get taken and equal highs or lows. Liquidity provides a reason for price movement. So instead of viewing the market as random candles moving up and down, let's start to begin to view it as a process of seeking that liquidity. Okay, here's some notes for you to have there. So let's look at this visual. In a bullish scenario or a bullish uptrend, the liquidity is going to be above the highs because we're trying to move the lows higher and we're trying to move the highs higher. So the liquidity would be focused on trading higher. So above each swing point, we would have buy side liquidity. Now, in the bearish scenario, it's the opposite. We would expect the highs to move lower and the lows to move lower. So if it's a bearish trend, then we're seeking sell side, sell side, sell side liquidity. Okay. Now, let's talk about a market ebb and flowing. We're on the buying side of the trend here, making higher lows and higher highs. So the liquidity at this point is on the swing highs. Okay. Now we shift below this low after taking out the high. So now that is our reversal bearish structure shift, right? So now we're seeking lows and the highs are getting lower and the lows are getting lower. So this is combining our structure shift with liquidity. You can see the market was seeking highs for buy side and then it shifted to a bearish trend and now we were seeking lows. So this is a really important slide for you to take a second to look at before you move on so that you understand that markets aren't just going to go one direction. They ebb and flow between going up and down. Okay, let's talk about a bullish scenario now with candlesticks. We have price creating a low, a high, and a higher low. So we're going to be putting our attention to the buy side liquidity above that swing high. Price trades above it, makes another higher low here and a higher high. So if we are going to continue a bullish trend, we will be seeking higher prices, buy side liquidity above this swing high. And the example continues to follow this process because the trend is established. So we're seeking highs. So seeking highs mean we're looking for buy side liquidity above old swing highs. Here's a bearish scenario with candlesticks. We have a high, we have a low, we have a lower high. So we would be focusing on trading lower. So this would be our sell side liquidity. After we take out this low, we leave a low here, make a lower high. So in a bearish trend, we want the highs to go lower and the lows to go lower. So we're focusing on seeking sell side liquidity below this swing low. And the trend continues. Let's do another example here. So we have a bullish trend. You can see that we had a higher high, higher low, higher high, higher low, higher high, higher low, right? And I also want to bring to your attention that the bullish trend reaches a point where there's an old high somewhere to the left. So although we're still seeking this high, we still want to pay attention to an old high being ran. I want to bring your attention to this low because this goes back to market structure 101. Trading above a high and then below a low is a bearish reversal market structure shift. We would monitor the swing point, see what happens next year. We create a lower high. So now we know we're not going to this high. And now we know that the liquidity that we are seeking is no longer this high because of the market structure shift. So you have to reference market structure 101. Trading above an old high and then below a low, failing to trade above this high means we're not seeking buy side liquidity anymore. Now we want to trade lower and look for swing lows to target. That's going to be our sell side liquidity. So what we just did there was combined a bullish trend that was seeking highs for buy side liquidity, and then a bearish trend that was seeking swing lows for sell side liquidity. It's important to acknowledge shifts in market structure so that we know what needs to happen for us to target a high or a low. Since we came all the way back down to where we started and traded below that low, that's an old low as well, and that is a sell side liquidity pool. The highs are moving lower and the lows are moving lower. The only low left to target for sell side liquidity is where we started from. So what we did here is combined an uptrend that was seeking swing highs in the form of buy side liquidity until we took out an old high. Then we expected price to trade above this high, but it shifted because we traded above this high and then below this low. That's market structure 101. That is a bearish reversal market structure shift. So the expectation is a lower high should form. And if that lower high takes out this low, we are now in a bearish downtrend seeking swing lows in the form of sell side liquidity. Okay, let's get to chapter 3, liquidity and market structure. Let's combine them. In chapter 1, we learned that location matters. In chapter 2, we learned that the market seeks liquidity. So now it's time to connect liquidity to market structure. This is where the narrative begins. Instead of identifying a bullish or a bearish structure, we now start asking, why did that structure form? More often than not, the answer begins with liquidity. Again, I want to emphasize that market structure does not move randomly, and it does not form randomly. Every swing high, swing low, breakout, reversal, trend continuation occurs because price is interacting with liquidity somewhere on the chart. So when liquidity is taken, market structure often responds. Sometimes liquidity creates a reversal. Sometimes liquidity creates a continuation. Sometimes liquidity provides the fuel needed for a breakout. So the key takeaway here is that liquidity acts like a magnet. It's constantly creating areas where orders are resting and price will be seeking those resting orders. So understanding liquidity will allow us to move beyond simply reading structure, and we'll begin to understand the story behind what we're seeing on the charts. This is where directional bias starts to become clear. Instead of asking, is the market bullish or bearish, we'll begin asking, what liquidity was taken and what does that tell us about the market's intent? That question is the foundation of narrative. So here's some key takeaways. Market structure tells us what price is doing. Location tells us where price is doing it. Liquidity helps us explain why price is doing it. When we combine all three, we begin building a narrative that helps us understand market intent and develop a directional bias. Let's talk about the importance of liquidity on this page. We already mentioned that it's the fuel that drives the market. Price needs liquidity to move. Without it, there's no flow. Markets move when the liquidity is taken, not when it's created. So you'll see liquidity often appear before reversals, new trends, and breakouts. So that does not mean that every liquidity sweep creates a reversal. However, many significant market moves begin with liquidity being taken. So understanding where that liquidity exists allows us to better understand what price may be attempting to accomplish. In order to talk about the importance of liquidity, we have to talk about why timing matters. There's liquidity everywhere on the chart. However, for building a strong directional bias, liquidity becomes more meaningful when viewed through time. Day traders are often going to focus on the liquidity created during specific trading sessions, such as Asia trading session, London trading session, New York pre-market trading session. And what we're looking at is the highs and lows of that trading session. So when we referenced earlier in the book, previous day high and low, we can create different windows of time session to session. These time-based liquidity pools frequently provide the fuel for the day's largest moves. So take a look at this line graph here. We have buy-side liquidity and sell-side liquidity. We have a trend being created between both the buy side and sell side. You can see that here. High, low, lower high, low, high, that's equal. So we have equal highs here, equal lows. This whole block of time here could be a previous day range. It could be a previous trading session range. So when you start thinking about price and grouping it with time, you start to understand that liquidity is resting above old highs and lows of previous sessions. And then, of course, this large move above this high, followed by the shift below this low, creates a bearish reversal shift. and then price fails to trade higher here and does what a bearish downtrend does, which is seek lows, and then ultimately seek the equal lows. So we're going to talk more about this as we continue to go through the book, but I wanted to reference why timing matters, because these moves are going to occur on a session to session basis. So let's get the candlesticks involved. We have price trading to a high and low. That is a significant range of opportunity. Now price creates these lows on the bottom down here, and then comes and creates these highs that are equal to each other. So the trading range is completely mirrored. So the only way to create a narrative of what's happening here is to identify the time in which it happened. So we'll just create this block of time to be the New York pre-market trading range. So from high to low, we now understand that that is the range. There's buy-side liquidity there because it's above the swing highs. Now I want to bring your attention to this low here. This is going to be 9:30 in the morning. This will be the start of the New York stock market open. You can see price not only creates a swing low, which is a higher low to the low of the pre-market trading range, it also trades below this low and then above this high. So now we have some information. It looks like we're in a bullish trend, trading above buy-side liquidity and also trading above the New York pre-market trading range. And now it's 9:45 a.m. and we have not only the buy-side liquidity taken, but we also traded above these highs and then below this low. That is, once again, our bearish reversal market structure shift. So now we have a range from this high to this low. It's 9:45. In order for us to know that we're going to trade lower, a lower high needs to be created. And as you can see, that lower high was created, which means the bearish trend has now developed after trading below this low, and we're seeking the sell side liquidity of the New York pre-market trading range. Let's do another example with candles. So here we have a low and a high. That's a trading range. And we have a higher low and a higher high. So in order for us to understand what we're going to do with this bullish range, we have to understand the time window. So let's just say that this is the New York pre-market trading range. We know it's a bullish trend. The last thing that they did was make a lower high and a lower low. So for this bullish trend to continue, when we make a lower low in a bullish trend, go back to Market Structure 101, what do we expect for it to continue? A higher high must be created. So let's bring our attention here. We're waiting for 9:30 a.m. You see how I created a lower high and then a lower low right after 9:30. Now we have a swing point. We haven't traded above the pre-market range high or low, so we need more information to determine what direction the trend really wants to go. So now price trades above this high after trading below this low. This is the importance of timing, because sometimes what looks like it's going to sell off and create a bearish trend, the immediate reaction by 9:45 is we traded below this low and above that high. Isn't that a bullish market structure shift? And it's the second type that I've taught you in Market Structure 101. It's the continuation market structure shift, because we identified the New York pre-market trading range to be a bullish range. Then 9:30 opens, trades here, makes a lower high, a lower low, and a higher high. That's the formula for a bullish continuation. We now expect from this low to this high to respect the bullish trend continuation and to trade higher off of this range, seeking the swing high of pre-market trading range. We've arrived to chapter 4, and we're going to talk about displacement and sponsorship. Now that we understand market structure and liquidity, we need to understand how markets travel between liquidity pools. Price leaves behind evidence. That evidence is called displacement. Displacement is one of the clearest signs that one side of the market has gained control. So what is displacement? Displacement is an aggressive break above any swing high or swing low. It represents an imbalance between buyers and sellers. So when displacement occurs, one side of the market is overwhelming the other. This causes price to move quickly with conviction. So some of the characteristics of displacement are going to be large candles, strong directional movement, consecutive candles in one direction, and very little overlap between candles. What this displacement tells us is that one side of the market is overwhelming the other. Price is moving with urgency. The stronger the displacement, the stronger the message being delivered by the market. Now, what is sponsorship? Sponsorship is a large impulse move away from key areas of interest. So when we see that, we can infer that displacement is going to be present. This does not guarantee a continuation. However, it tells us that significant buying or selling interest has entered the market. So here's some signs of sponsorship being present: strong displacement, fast expansion, aggressive movement away from liquidity, and clear directional intent. So you may be asking yourself, well, what's the difference between sponsorship and displacement? The main difference is that sponsorship comes before displacement. It's going to be the impulse away from key areas of interest, whereas displacement is describing the aggressive break above a swing high or swing low. Let's get into some examples. Here's the flow for what we're going to be talking about today. We have the condition, we have the sponsorship, the displacement, and then the shift being validated. So let's talk about two types of examples: a bullish reversal example. We have a market that is in a downtrend. And then I want to highlight this area here: price trading aggressively away from that area of interest is showing the sponsorship. You can see that large impulse away from price going lower. It just said, we're not going lower now. We want to go aggressively away from that downtrend and start trading higher. That is sponsorship. Now, the rest of the example shows that not only does price shift structure above this high after taking out a low, but this large movement with consecutive up candles above that swing high is the displacement. So you can see here the sponsorship starts with the intent to move impulsively away from that lower part of the chart, no longer wanting to trade lower in a downtrend. The shift above that high after taking out that low, and then price moving aggressively above that swing high is the displacement. Let's talk about a bullish continuation example. So here we have a bullish uptrend. We see that within this uptrend, we have a large impulse above this high. This is what confirms that we're in an uptrend, because before we just had a low, a high, and a higher low. But aggressively pushing above this high is our sponsorship. We know that the market's intent is to continue trading higher. So the trend continues, and then I want to bring your attention to this low here. If we're going to be bullish, trading above that high here and then below this low is a bearish market structure shift. So what we want to see for the sponsorship to be followed up with displacement is aggressive movement above this key low form. And remember, all a key low means is that we're bringing our attention to it because we're identifying the trend being bullish. We expect it to continue higher. So we need to see displacement above that last shift lower. And that's what we get here. So continuation market structure shifts are going to be our trend trading entries. We've arrived to chapter 5, and here I'm going to introduce gap formation. A fair value gap, FVG, is an inefficient delivery of price created by the displacement. It occurs when price moves so aggressively that a gap is left between candles. A fair value gap is a 3-candle pattern. The middle candle creates the imbalance. So this is a visual of what I'm talking about. So I want to talk about BISIs and SIBIs. So we identified how a gap is formed. Now I want to give context. What makes it a buy-side imbalance, sell-side inefficiency, a BISI, it's created by bullish displacement. So BISI isn't just a bullish fair value gap, and SIBI isn't just a bearish fair value gap. So think of BISIs and SIBIs as displacement gaps because they're trading above or below a swing point. Let's talk about the narrative flow. So instead of teaching gaps as a standalone concept, I want to connect them directly to what you've already learned. So we know in the reversal shift, there's a 5-step process that we go through. We understand that there's a market condition. We look for sponsorship to enter the market, followed by displacement. Now, after that displacement occurs, we want a BISI to be formed, because if it's a bullish displacement, it'll be a bullish fair value gap being created above the swing point that creates the market structure shift. So step 1, identify the market condition. Step 2, look for where the sponsorship enters, which is where the impulse move is, followed by a displacement, which is going to create the BISI or SIBI above the swing point and confirming that the shift is validated. Okay, let's identify what a bullish fair value gap is. So here we have a 3-candle pattern. This is the wick high of candle 1. We're outlining that area. This is the wick low of candle number 3. So this is point number 2 of identifying our fair value gap. As you can see, extending the line out 3, 4, between point 1 and 2 is our fair value gap. Our bearish fair value gap will also be a 3-candle pattern. Candle 1, you see the point there. It's point number 1. We extend that out. Candle number 3, you see the point on the high there. That's the second point. We extend that out. By extending the line out to 3 and 4, between the point 1 and 2 is where the fair value gap is. That is a valid bearish fair value gap. So we've already mentioned the conditions for a reversal shift and continuation shift, and we're going to follow this 5-step process. So here we are back at the previous example. We are in a downtrend. We see the sponsorship of price no longer having intent to trade lower. We get the sponsorship of an impulse move away from the down movement. We see that we have the market structure shift here. So we have our displacement that creates our bullish fair value gaps and our BISIs because they're trading above that swing high after taking out the low. So we have a reversal market structure shift to the upside, followed by a displacement that creates multiple bullish fair value gaps. Let's look at the bullish continuation example. So we have our sponsorship because this is when our trend was confirmed to be bullish. We had the impulse move higher. We had our market structure shift here. We have our kilo that we're putting our attention on because for the bullish structure to continue, we have to make our higher high. We know that displacement occurring above this low confirms that we are going to continue to trend. And then we want to highlight our BISI, which occurs as we displace higher. and it validates the shift is a continuation shift. So you can see here in these examples, all we added was the BISI. Adding the BISI gives context to what the displacement creates above the swing highs and swing lows. Okay, chapter 6, interbank dealing ranges. So this is just going to be an introduction to interbank dealing ranges. In Market Structure 101, we talked about what a downtrend consists of and the expectation of a lower high followed by a lower low. We also discussed how during a downtrend, if price trades above a lower high, the next swing point that forms above that high becomes a key high. So once that key high is established, we expect price to quickly create a lower low if bearish trend is going to continue. Now, in Market Structure 102, we're going to be introducing the concept of the interbank dealing range, IBDR. And in the example I'm going to show you, we're going to be focusing on a trend continuation, IBDR. So first of all, price comes from that high to this low. We create a range, and then we make a lower high and a lower low. Now, what I want you to focus on is notice how price first trades above the swing high here. Okay. And then below a swing low. This is the same process we used when we were identifying a market structure shift and Market Structure 101. However, instead of focusing on the shift itself, we're focusing on the new dealing range that is created as those new swing points form between this high and this low. The newly established swing high and swing low now define our interbank dealing range. This range is going to give us framework for identifying premium and discount and ultimately where we want to participate as the bearish trend continues. So rather than trying to predict a reversal, we're going to be using the IBDR to locate high probability continuation opportunities within the existing trend. So the key takeaway here is an interbank dealing range is a dealing range that forms after running two swing points in the form of liquidity. It is established once the next swing high and swing low are formed and trading outside of the previous range. So here we have a high to low. And then I wanted to get some candlesticks involved. So you can see that the trend was trading lower and then price started reaching for that high and then this low. So now that we traded above that swing high and below that swing low, we put our attention to this new interbank dealing range. For the trend to continue bearish, we wanted to see a new bearish price swing. So we've just connected that high to low. And now we have a range of opportunity where we can focus on the premium and discount. All we did was highlight the range, create a midpoint between the high and low, and anything above that 50%, which is equilibrium, will be considered the premium portion of the range, and anything below this black line will be considered the discount of the range. Okay, let's do another example. So here we have a low, a high, a higher low, followed by a higher high. So we're going to highlight that we traded above this swing high. Now, notice that we trade aggressively below this swing low. So do you see the difference between this example and the previous? In the previous example, we were continuing a bearish trend. In this example, we're reversing into a bearish trend. So our range of opportunity went from being a bullish range from this low to this high. But now that we traded above this swing high and below this swing low, now we have a reversal IBDR swing high and swing low. We have our range to tell us expensive prices or cheaper prices above our 50% level, we have our expensive prices, and below our 50% level, we have our cheaper prices. And here's some notes for you on reversal IBDRs. A reversal IBDR forms against the current trend. In a bullish trend, price first takes out the previous external range high to grab liquidity. This liquidity sweep triggers a market structure shift as price reverses and breaks below the previous swing low. After the shift, price forms a new internal dealing range between the first swing high and the swing low that formed after the market structure shift. This internal range is where institutions will likely accumulate, distribute, and manipulate price before the next expansion. So, reversal IBDRs are going to be used to identify high probability entries in the opposite direction, typically from premium to discount in a bullish trend. Let's do a candlestick example here. So here we have a bullish uptrend because we're creating high, higher low, higher high. Price trading above this high means that we're confirming a bullish uptrend. Then price quickly moves below this swing low, reversing a bullish trend to a bearish trend. So we have a reversal market structure shift. And we're highlighting the range that's created from that high to this low, which confirms our new reversal IBDR swing high and swing low. And we have our premium and discount identified. So this concludes the last chapter of our Market Structure 102 book. What have we learned today? We learned that market structure tells us what price is doing. We learned that location tells us where price is doing it. We also learned that liquidity helps explain why price moved there. We introduced the concept of sponsorship and displacement to reveal market intent. We introduced how gaps form and provided evidence of aggressive price delivery. We also made sure to identify the differences between BISIs and SIBIs. And finally, we talked about interbank dealing ranges to help define high probability areas for execution. Well, here's the key insight. A setup is not created by one concept. High probability trades are created when multiple concepts align. So the more pieces of the puzzle that agree, the stronger the narrative becomes. It's all about building framework. You have to see it, connect it, and execute it. Here's a visual for you to print out and keep next to you on your desk. What I want you to focus on is mastering the relationship between structure, liquidity, displacement, gaps, and dealing ranges. If you can do that, you'll be able to build a clear narrative before every trade. I want to thank you for taking the time to read Market Structure 102 with me. My goal wasn't to give you indicators. My goal was to give you a complete framework that explains how price moves. You now understand structure, location, liquidity, sponsorship, displacement, gap formation, and interbank dealing ranges. This is the blueprint I use to break down every chart. Simple, logical, and repeatable. The goal is not to predict. The goal is to prepare. When you prepare with structure, you can execute with confidence. Keep studying, keep applying, keep sharpening up, keep growing. The charts will continue to teach you. My final takeaway is going to be, if you can identify market structure, you can control direction. If you can identify market conditions, you can understand the context. And if you can identify interbank dealing ranges, you can execute with an edge. So if you found value in this video, please subscribe to the YouTube channel. You can reach out to me via email at devotedpips@gmail.com. I'm on X, Twitter at GoodEatsFX. Also, if you would like to reach out about mentorship and resources, my link tree is provided in the comments below. Thank you again so much for participating in the Market Structure 102. Signing off, Devoted Pips. Peace.